Welcome to this particular course on this entrepreneurial manager and good morning. And the topic we're going to see again is actually with respect to this unit 4 financing of enterprise. And here you want to see a very important topic which is called export capital. So this is actually the overall the contents which you're going to see today. So we're going to see how in depth we're going to see all these particular topics. So introduction to export capital. Now let us get into the introduction. So export capital is nothing but a financial support. Again, it is as you clearly mentions the name of the capital. It's financial support, which is actually provided to enterprises. But the key distinction here is the enterprises here should be engaged in international trade, not a domestic enterprise. So this is some of the advantages of export capital. They help manage the working capital. Shipping logistics becomes a major factor, and payment risk is very critical because all the customers are outside the country. So next, why export capital is very important is it reduces the financial burden because the payment cycle is going to be very long, and since the buyers are going to be abroad, they are foreign from the foreign countries, and they protect the firms from credit risk. And many organizations requires backup of the export capital organization, so that what happens, large global orders are being given, and it enhances the competitions in the international markets. And documentation requirements is actually hugely supported by the export capital organizations. Now, what are the key features of the export capital? It is a short and medium term financing, which is supported by actually government export agencies, and they cover the pre-shipment and the post-shipment needs, and then there is a subsidized interest rates and export-friendly repayment terms. Now, these are the types of the export capital we have for the pre-shipment finance, for example, for purchasing raw materials, processing, packing, and logistics. And then post-shipment finance for managing the credit period given to the foreign buyers until the payment is received. Export guarantee protection against non-payment and political risk. This is a very important factor. Export credit insurance and export credit guarantees, and then suppliers credit. Exporters provide credit to buyers with bank support. So this is actually a very important point of view. And buyers credit. The bank's financial institution provides credit directly to the importer. The pre-shipment export finance is offered as a credit loan and available in Indian or foreign currency. And based on the confirmed export orders or letters of credit (LC), the pre-shipment export finance is done. Post-shipment export finance is given after the shipment of the goods or particular is done and until the payment is realized. So there's a crucial time period here in between, and these are some of the examples of bill discounting, export bills negotiation, and advance against export incentives and subsidies. And here helps the exporters maintain cash flow display long payment cycles. These are some of the institutions offering export capital: Exim Bank of India, commercial banks, Export Credit Guarantee Corporation, risk protection, SIBI, export support for MSMEs, export-oriented NBFCs, and international institutions like Asian Development Bank. And this is the process of export capital financing process. Export letter of credit is obtained, then the application has been done, and then the shipment is done, and then post-shipment finance request is done, then shipping documents have been submitted. The bank verifies the compliance of the genuineness of these documents, and then payment is realized from the foreign buyer, and then the load is settled. Now, these are some of the documents which is required: your confirmed purchase order or letter of credit, shipping documents, bill of lading, exporters, importers code, bank statements, and GST and business registration. So cost, what are the costs of the export capital and the interest rate? Interest rates are often subsidized under RBI's export credit policy, lower than domestic working capital loans. Interest rate linked to LIBOR, so that is actually a benchmark for foreign currency loans. The advantages is definitely you have this improved working capital liquidity, reduce risk through insurance and guarantees, encourages enterprises to explore new markets, and enhancing the global competitiveness. These are some of the challenges and limitations. The documentation is quite complex, and compliance is also very challenging here. And currency fluctuations, because of the international nature of the currency, is also a huge risk. Buyers sometimes delay the payments, and then there is also risk associated with the country as well as the economy, which actually the importing and exporting has been done, and high operational cost. So this is the comparison of export capital versus domestic financing. You can see the risk cover is very important. The cost is also lower, but in domestic finance it is higher. Payment cycle is longer, and the currency is also foreign currency, whereas in domestic finance is also in. There's a small case study where export capital in action was actually demonstrated. You can quickly see from the slide. The government schemes supporting export capital. These are some of the government schemes which are supporting the export capital. Interest equalization scheme, ECGC export credit insurance scheme, and duty drawback and road ups incentives. Trade infrastructure by export scheme and SEZ and year supporting infrastructure. So these are some of the best practices for enterprises. Use hedging tools is some innovative thing which is coming up. Monitoring the currency trends and investing in quality and compliance certifications also huge goes a huge way in getting the trade finance. Emerging trends in export financing is digital fintech is come, blockchain has also come, and ECSG environmental social governance norms are also coming. So to summarize this, export capital is very important for firms in global trade, and it covers three stages. One is the pre-shipment, post-shipment, and the risk protection needs. And it also enables enterprises to scale up internationally, and government schemes play a role. So thank you very much for listening. Thank you very much.